How do you know if a market trend has any real juice behind it, or if it's just, well, noise? Today, we're going to pull back the curtain on a tool that's basically a speedometer for the market. It's called the Average Directional Index, or ADX for short. Let's break down how to use it.
It doesn't matter if you're a rookie or a pro. Every single trader fights the same battle every day. Just plain old market uncertainty.
I bet this feels familiar. You see a price start to move, you jump in thinking, yes, this is the one. And then nothing. It just fizzles out, reverses, and you're left holding a losing trade. It's got to be one of the most frustrating things out there. And it isn't just those fake breakouts, right? It's that feeling of being stuck in a market that is going absolutely nowhere. Or maybe worse, you get scared and you jump out of a huge trend right before it really takes off. Or you lack that confidence to know if a move has any real power behind it. These are the exact problems the ADX was designed to help you solve. So how do we cut through all that confusion? Well, what we need is a tool that doesn't just tell us where the market is going, but how fast it's getting there, and with how much force. So it's time to meet the market's speedometer. So the ADX, the Average Directional Index, it's a technical indicator that does one job, and honestly, it does it really, really well. It measures the strength of a trend. Now listen to those keywords. It does not tell you if the trend is up or down. It only tells you how strong that trend is. This is the perfect way to think about it. A high ADX reading? That's like glancing at your car's speedometer and seeing you're flying at 100 miles an hour. You can feel that momentum. A low reading, you're just crawling along in traffic. It puts a real hard number on a trend's energy. But look, speed is only half the picture, isn't it? You also need to know which direction you're heading, and that's where the rest of our trading dashboard comes in. The ADX line is your speedometer, sure, but it comes with two other lines that act like a GPS, the plus DMI and the minus DMI. They're the ones that tell you if all that momentum is pointed up or down. Okay, so you've got this dashboard right in front of you. How do you actually read the signals and start making better decisions? Let's get into the rules of the road. So this is basically your cheat sheet for the speedometer. If the reading is below 20, the market's just drifting. It's weak, probably best to stay away. But once the ADX crosses above 25, that's your green light. That's the signal that the trend has enough power to be worth your time. And, hey, the higher it goes from there, the stronger that trend is. Now let's look at the GPS, your directional lines. The rule here is super simple. When the green line, that's the plus DMI, is above the red line, the minus DMI, the bulls are in charge and prices are heading up. And when that red line crosses above the green, well, the bears have taken over and prices are moving down. Simple as that. And here it is. This is where it all comes together. You don't use these signals by themselves. The magic happens when you see the DMI lines cross over to give you direction, and you wait for the ADX to rise above 25 to confirm that the trend has real strength. Speed plus direction. That, my friends, is a high-confidence trading signal. Okay, theory is great and all, but let's see how this actually works in the real world. We're going to walk through a case study and see how this whole thing builds a complete trading plan. All right, let's walk through a trading gold. So step 1, consolidation. You can see the price is just chopping around sideways. Our speedometer, the ADX, confirms this. It drops below 20. This is what we call a do-nothing period. Step 2, the breakout signal. And then we get it. The green plus DMI crosses over the red minus DMI. But crucially, the ADX wakes up and it pushes above 25. That is our signal to get in. Step 3, ride the trend. So a trader goes long, and as this trend really picks up steam, the ADX climbs all the way to 65. That's a very strong trend, and it gives you the confidence you need to stay in the trade. And finally, step 4, the exit strategy. The ADX peaks and starts to roll over. That's our early warning sign that momentum is fading, and it might be time to start thinking about taking those profits. So what this does is it really simplifies your whole approach. When the ADX is low, below 20, trend-following strategies are probably just going to get you chopped up. So instead, you might look for reversal trades. But when the ADX is high, above 25, you do the complete opposite. You use trend-following strategies, you buy the dips, and you let your winners run with that momentum. And that's the real power here. A tool like the ADX helps you take all that emotion, the gut feelings, the hope, the fear, and replace it with a clear, objective signal about what the market is actually doing. So why does all this matter? I mean, what's the real, tangible edge that the ADX gives you over other traders out there who might just be guessing?
Let's just quickly recap your new edge. With the ADX, you can now objectively measure trend strength. You can help filter out all those weak, fake breakouts. You can get the confirmation you need to let your profits run. You can identify those choppy, directionless markets to avoid, and you get an early heads up when a trend might be running out of gas.
If you remember only one single thing from this entire explainer, please make it this number, 25. When the ADX crosses 25, the market is basically screaming at you that a trend has enough momentum to be taken seriously. It's your line in the sand between all that market noise and a real tradable move. So, the ADX gives you the diagnosis. It tells you the health and the strength of the trend. But the next step? Well, that's always going to be up to you. So how will you use that information? To stay out of bad trades or to confidently ride the great ones?